Let's get back to tech and dive deeper into the sell-off with the viewer question from Apple, from Bill in Virginia.
Greetings from Culpeper, Virginia. My name is Bill Bertoni. Apple stock is a stock I've owned for close to 10 years. I've been accumulating shares, and it currently makes up 55% of the overall investments I have in my retirement and my wife's and my personal investment accounts. We've lived through the 7-to-1 split, the 4-to-1 split now. We've recovered all the initial investment we made into Apple. My question is, what should we do now? Should we sell off some or keep holding it? It's a good dividend stock for the future. Thank you.
Wow, talk about a concentrated portfolio. Karen, what do you tell Bill?
Yeah. Well, there's a lot going on there in that portfolio. First of all, congratulations to have owned it from way back when. Extraordinary gains. So that's going to lead me to, well, whatever you do sell, you're going to pay long-term gains, but you are going to pay taxes on that. So that's something to consider. But the overriding thing, the 55% concentration is very troubling. So for that reason alone, regardless of where it is, if this is your retirement account, I don't know how old you are, but I would not be owning 55% of anything in my portfolio. I just couldn't do it. Bonawyn can really speak to portfolio management. I don't know, maybe he's fainted when he heard that 55%, but I think you have to take some off the table, either via puts or selling some, just to get down to just to diversify your risk.
Bonawyn's still conscious. But you know, I think people like Bill Bonawyn might say, you know, but this has been a winner. Look at all the gains that I've had. How can if I had a prudent portfolio management or whatever you want to call it way back when, my portfolio wouldn't be nearly as big as it is today.
And he would be right. Listen, portfolio management and diversification isn't about hitting a home run on everything. A large part of it is about having building blocks so that you can build wealth in a sustainable way over time. So again, kudos to you for the calls on Apple. But yes, to Karen's point, 55%, I hate to do it, and I know you probably will fight me on this, but you need to rotate into something else, anything else. If for no other reason than you have so much of your wealth now concentrated in that one name, if something were to happen, I just fear for what that might mean for your wealth and liquidity position.
Okay, so what if Bill says, all right, I'll sell some of my Apple guy, but I'm going to buy Skyworks and Intel and Facebook and Amazon?
Yeah, I mean, you know, my sense is, and again, Bonawyn does this, he understands it, but you should get into things that sort of are not in the same vertical. You know, diversify means exactly that, diversify. And maybe it's 55% Apple now because of the gains, and it's just organically grown to 55% of your portfolio. But I think we would all agree, just in terms of the absolute number, that's too high for any one stock. And keep in mind, and look, you know, I've liked Apple, I haven't liked Apple, I've been right, I've been wrong, but over the last 2.5 years, you've seen drawdowns of 30% and north of 35%, pretty much in a straight line if you go back to 2018, and then as recently as January and February. So it's not like this stock doesn't sell off. Down 12% now. I don't know if this is the beginning of something. But in the back of your mind, you have to have a plan. The plan can't be after the fact. I think you have to have a plan before. And right now might be that before point. So 55% too much. Maybe it should be more in the 20s, in my opinion, percentage-wise.